So next, we're going to talk about how ETF expands so quickly and efficiently into asset classes such as equities, fixed income, emerging market, and various other alternatives. Now, what is the engine that enable this to happen? The secret sauce lies in what is called indexing. Now, indexing is where you have what is been issued by index provider, which we'll look at in a short while. Now, the index provider are people like, for example, S&P 500, S&P, MSCI, MSCI World. We're going to look at some example in a short while. But how an ETF tracks an index predominantly rely on these four methods of tracking. When I say tracking means how does it, follow the index, so to speak, follow the index. Now, for example, if you look at our STI index, the FTSE STI index, it's made up of 30 component stocks in various percentages, right? It is the ETF, the two ETF that we have that are listed on the SGX are based on what is termed as full replication method. Full replication simply means that whatever the index detect in terms of the component percentages, the ETF will invest in exactly the same manner. And we call that full replication. However, if let's say instead of investing in all 30, the ETF decided to invest in only 10, that is what will be termed as a sampling approach. In other words, you take a sample and then you use it to represent the entire holding that the index is tracking. Of course, there's no need to do that for STI index. There's only 30 stocks. It's easily trackable. The second approach, the sampling approach, is typically used in an index, let's say a fixed income index that tracks a few thousand individual security, and that can present a challenge in terms of fully replicating the index. Another third approach is what I will call an optimization approach, and this is an approach whereby instead of investing in the underlying security itself, you invest in a portfolio that feature high correlation to the index. And you may ask, why would an ETF want to do that? Now, this approach will be taken in a situation whereby the underlying security may be difficult or impossible to invest due to maybe various barriers to investing in countries that are in the emerging markets that may have certain restriction against foreign investor or against fund managers investing fully in the index. For example, you look at countries like China, Taiwan, and various emerging market countries all have various protection erected in their local security market. And this is where optimization approach comes in very handy. And another approach that will come in very handy to overcome such barrier is what I would term as a synthetic replication, which is the last method that we'll cover. And this is done through the use of financial derivative or embedded financial derivative to replicate the index performance. And this is typically done via what is termed as a swap contract, right? A swap contract. Now, I always like to illustrate a swap contract using a very simple bet that you can place with your friend. For example, now placing a bet, we all have friendly bets on, for example, soccer game, right? Let's take, for example, if you watch an English Premier League that is playing, let's say, the coming Saturday, and you have a friend that is, you want to make the match more exciting. You say, let's bet a small amount of money, which each of you supporting one of the other teams. And whoever win the bet will collect the earnings. So for example, if you bet $10 each, the winner will walk away with $20. Now, a synthetic replication makes use of a swap contract, very similar in nature, right? But the trouble with such swap contract is this. When we talk about friendly bets between friends, small amount, it's very easy to settle. But what if you start to bet on big amount, right? Say in the range of $1 million, $2 million, but in the space of the institution, we're talking about millions and potentially even billions involved. And this brings up what is termed as a credit risk. Now, credit risk means that you could win the bet, but not receive the payment because your counterparty is unable to pay up. And that's what credit risk is involved, which also explains why synthetic replication is a slightly higher risk than the other three. So some example of plain vanilla index, the S&P 500, most well-known market barometer in the world. You have the MSCI Asia ex Japan. You have got the MSCI World Index. Now, all these are plain vanilla index. And of course, you have our STI, which I will spend quite a bit of time on later on. But the point is that the ETF is able to kind of expand into so many other asset classes, due largely because there are so many index being created in these various asset classes, in equity, fixed income, cash, currency, commodity. So this is the local context. In terms of equity, you see that you can gain exposure to STI, you can gain exposure to S&P 500, you can gain exposure to high yield investment grade bond funds, you can gain exposure to commodity, spot gold, and of course our favorite asset class here in Singapore, one of the favorite investor asset class is this thing called REITs. In the last few years, this has proven to be a very attractive proposition, which we'll touch on later on in the workshop. So there are many index providers globally. This table just goes to show on a global basis what are the major global players that we are talking about, giving you a bar chart showing in terms of market share, what we are talking about. And bear in mind that this index provider, in today's context, they are a very powerful force in the investing universe. Why is this the case? Can you imagine just an announcement by the index provider to change certain competition will be enough to move the market? So this is an example. Singapore stocks slide. So this is taken from the Straits Times back in 2020. The reason, MSCI Singapore drops ComfortDelGro, SATS, SCI, and SPH. Just one announcement like that, the SGI drops 15.80 point. And this is the announcement simply by an index provider, right? So the power of the index applies to even country index like China. If MSCI announced that they are going to increase its coverage, the impact will be felt on the stock market. Now, the next question is, why is this the case? How is it that, whenever they announce such a change, it moves the market? Well, there are two things, of course. You can roughly gauge that there are ETF tracking the index, right? Let's say we talk about MSCI Singapore Index. There are, let's say, ETF tracking, but we don't use MSCI Singapore in the tracking for our STI index, right? We use FTSE, but why does it still move? Well, the other aspect is that MSCI Singapore acts as a benchmark for a lot of active manager. Now, benchmarks means it's a yardstick whereby they measure an active manager's performance, whether they can beat the index or they fail to beat the index. Now, for professional career risk management, most active fund manager, when they see such announcement or such impending announcement, they will similarly make certain changes to their portfolio, which also explain why whenever such announcements are in place, the whole universe of active managers and passive managers are all involved. That's why the market moves on such announcement. That gives a lot of power to the index provider. Now, this is a chart, this is a table which gives you a bird's eye view of the various expense ratio. On the right-hand column is the average total expense ratio in basis point term of various asset classes. So to sum it up, equity ETF on average 37 basis point, fixed income 16. If you combine all the rest, it's about 31. Now, compare that to what you see below on the bottom table, looking at actively managed equity, international equity, and also fixed income. You realize that the total expense ratio is a very substantial difference that we are talking about. And if you are, managing your portfolio, this will all make the difference when we look at the portfolio performance at the end of an investment time horizon. Now, to use a metaphor, this is like having a 100-meter race in a very competitive sports, whereby your competitor, the active fund manager, is running with you, but he's pulling a tire, a weight along with him. Whereas you are running just with the most efficient pair of running shoe. Your active person, your active fund manager is running with the weight that's tied to him. And this is where people say that if you want to kind of outperform your neighbor, and this is of course assuming that your neighbor is using an active approach. If you use a passive approach, you will already gain the extra total expense ratio when the race haven't yet started.